Profit margins are one of the most important indicators of a company's financial health and efficiency. There are several types of profit margins. They show not just whether a company is making money, but how effectively it is managing its costs relative to its sales. Gross profit margin reflects the percentage of revenue left after subtracting the cost of goods sold, COGS. At their core, profit margins measure how much of every dollar of revenue a business keeps as profit after covering expenses. It focuses on the efficiency of production and the direct costs tied to creating a product or service. A high gross margin indicates that a company can produce goods at a relatively low cost compared to its sales price. Operating profit margin takes into account operating expenses such as rent, salaries, and utilities, in addition to COGS. This margin reveals how well a company manages its day-to-day operations and overhead. Finally, net profit margin is the bottom line, the percentage of revenue left after all expenses, including taxes and interest, are deducted. Net margin gives the clearest picture of overall profitability and is often the figure that investors and stakeholders pay closest attention to. For example, if a business generates $1 million in revenue and reports a net income of $100,000, its net profit margin is 10%. This means that for every dollar earned, the company retains 10 cents as profit. Profit margins vary significantly by industry. Grocery stores, for instance, often operate on very slim margins, sometimes below 5%, relying on high sales volume to generate profit. Luxury goods companies, on the other hand, may enjoy margins well above 20% because of their ability to charge premium prices. In competitive markets, maintaining healthy margins can be challenging. Rising raw material costs, increased labor expenses, or aggressive pricing strategies from rivals can quickly erode profitability. Companies must balance competitive pricing with cost control and strategic differentiation. Strong profit margins allow businesses to reinvest in growth, pay dividends to shareholders, and build financial resilience. Weak margins, on the other hand, can signal inefficiency, over-reliance on debt, or unsustainable pricing models. In short, profit margins are not just numbers on a financial statement, they tell the story of a company's efficiency, competitiveness, and long-term viability. For any business, keeping a close eye on margins is critical to survival and success.